and the rest of the small caps just about positive by 0.1%. There's the opening bell, switch of the board and get to the bond market. Yields on quite a trip, quite a ride since the Fed last met in early May. We closed that day, May 3rd, at about 380 on the front end on a 2-year. Added some serious weight to the front end of the curve, up to about 460 this morning, so 80 basis points higher from the last time the Fed met. This dollar has been stronger. It's weaker this morning. Euro dollar positive by 0.4%, 108.37. Crude positive too, back through 70 this morning. $70 and about 30 cents, up by 1.2%. Around the open then, about 25 seconds in, we are almost totally unchanged on the S&P 500. On the Nasdaq, unchanged as well. One stock that has not been unchanged over the last 13, 14 days, Tesla. The EV maker set to extend gains for a record 14th consecutive session. Morgan Stanley analyst saying, quote, the market wants to believe Tesla is an AI name first, an auto company second. The company also raising the price of its Model Y in the US once again. Ed Ludlow up early for us this morning. Morning, Ed.
Good morning, Jonathan. Tesla is up for a 14th consecutive session, extending that record. We're higher by about 0.3%, but we are bouncing around on the stock. $242 billion of market cap's been added over that 14-session streak. There's some key data points and technical analysis that needs to be done. Tesla's $242 billion market cap gain is greater than the standing market cap of 90% of the members of the Nasdaq 100. So when you reflect on Morgan Stanley and Jonas's call about valuation and the reconsideration that investors are doing, that's probably important to know relative to its index peers. The other part is a technical analysis on a relative strength index basis. 14-day RSI, we're at 88. On a 0 to 100 scale, anything over 70 on an RSI is in overbought territory. So we're deeply into overbought territory. In terms of the news flow, no clear catalyst out there when it comes to Tesla. They did raise the price of Model Y in the US again, this time by about $250. There's also that added momentum around what we're seeing in North America with GM and Ford, but also rival charging infrastructure players saying that they will add the NACS standard to their charging offering. How long does it keep going? Anybody's guess.
Ed, I'd love your perspective as well. I was talking to David Welch about that price hike. It's $250. Have you got an idea of what the price strategy is here now at Tesla?
Just really quick, John, we're now down 0.7% on Tesla. Such is the market, so that's probably worth noting. Who knows where we'll be at the close. Pricing has always been a lever for Tesla. You know, that Elon Musk has talked pretty consistently that in order to protect growth and volume, they're happy to sacrifice profits. You know, at the beginning of the year, they cut prices to great effect and unlocked a pocket of demand in January. Elon Musk talked about demand being twice the rate of production after they had cut prices. Now we've seen them ramp back up again. $47,740 is the starting price for a Y. You compare that to the US median or mean average price of a new vehicle, it's still slightly below, so it makes them competitive. It's a lever.
Ed, we're softer, just a little bit. Ed Ludlow, thank you. We're down by about 0.5%. 13-day winning streak before today. More than $200 billion of market cap added to that stock. We mentioned Adam Jonas and Morgan Stanley, still overweight Tesla. He wrote this. Here's the fuller quote. The market wants to believe Tesla is an AI name first, auto company second. Suspect many investors may be again looking at ways to justify the valuation beyond the confines of a unit price automatic hardware model. Just amazing to see what this name has done over the last few weeks, that's for sure. Let's turn to the chip makers. AMD giving investors a peek at its upcoming line of, guess what, AI processors. As demand continues to heat up, the company planning to introduce a product that speeds up processing for generative AI like ChatGPT. Abby has more. Hey, Abby.
Yeah, it's hard to get away from AI at this point, John. And this stock has really been all over the map relative to this event and the unveiling of this processor yesterday after the event. Down about 3% earlier in the pre-market, up nearly 3% moments ago, up just fractionally. Right now, up less than 1%. So investors trying to figure out what it means, but essentially what you were talking about, these processors are meant to handle all of the traffic that comes in from the generative AI. CEO Lisa Su saying it's going to be a huge, huge market, $150 billion in potential. Their key customers will start sampling the technology in the third quarter. Analysts somewhat positive, saying that this puts them in the league with NVIDIA. NVIDIA, by the way, does have that $1 trillion market cap, even though it's down slightly right now. So it's hard, again, to get away from AI. AMD now officially in the game.
Up 1%. Abby, thank you. You just have to say the words AI, the letters AI, and all of a sudden you generate a bit of a rally. We mentioned NVIDIA. Let's talk about it. NVIDIA in the spotlight over share buybacks. Isabel Lee has the story. Hey, Isabel.
Hi, John. Many in Wall Street do love to dig into the reasons behind buybacks. But yes, this is sparking chatter, especially after the last fiscal year. So NVIDIA, after a 3-year break, decided to spend more than $10 billion repurchasing their shares after a monster rally ahead of AI, which, to Abby's point, NVIDIA has hit the $1 trillion club, which is only the 7th company in the U.S. to close in that valuation. So in hindsight, this was a fantastic timing because shares have since doubled since then. And so now, despite having more than $7 billion in buyback authorization, NVIDIA isn't doing anything. And some are saying this is a warning sign, while some are also saying maybe they just want to have a little cash on hand, John.
Why would they? Isabel, thank you. They made the decision hundreds of millions of dollars of a market cap ago. Isabel, thanks again. The stock is basically unchanged. I want to turn to healthcare. Some of this healthcare news is slightly depressing. United Health seeing higher costs as seniors catch up on surgeries delayed by the pandemic. The CEO speaking at an investor conference saying, we're seeing as behaviours kind of normalise across the country in a lot of different ways that more seniors are just more comfortable accessing services for things that they might have pushed off a bit, like knees and hips. Katie has more. Hey, Katie.
Hey, John. Well, that catch up in surgeries is bad news for the insurers, including, of course, for United Health, which is the biggest of the group. Shares currently down about 8.7% and 8.8% at the moment this morning after that investor conference. And an increase in surgeries, such as those joint replacements that you mentioned, usually means higher expenses and higher premiums. You also have the CFO, John Rex, warning that second quarter premium revenue spent on that type of care may be at the upper end or, quote, moderately above expectations. And that warning, it's leaving its rivals lower as well if you look at Humana and you look at CVS. And at its heart, this is a pandemic story, since according to RBC, these are the types of procedures that were basically deferred over the past few years, particularly among Medicare Advantage patients. And now that pent-up demand looks like it's going to push up costs for those insurers as well. Quick check again on United Health, currently off by more than 8%.
The wrong kind of pent-up demand there. Katie, thank you. Katie on the latest with the healthcare providers. The market right now, about 7 minutes into the session more broadly, still totally unchanged on the S&P, going into the Federal Reserve decision later on this afternoon. After hiking interest rates for 10 consecutive meetings, the Fed is potentially gearing up to take a pass on today's meeting. It would make it the first pause since the day the hiking cycle began on March 16th last year. That day, the S&P 500 closed at 43.57. An aggressive 500 basis points later, after rallying through 3 of the biggest bank failures since 2008, a bear market became a bull, and this market closed yesterday at 43.69. Victoria Fernandez across Smart Global Investments joins us now. Victoria, it's like the hiking cycle never happened, isn't it?
Yeah, it is. I mean, it's according to the equity markets, like you said, we're back where we were almost a year ago. But I think it's a sign that in the equity market's mind, the Fed is coming to an end of what they need to do of the rate hikes in order to tamp down inflation. I'm not sure I 100% agree with that. You know, there's a question in regards to what it means for the Fed to tamp down inflation. Are they going back down to 2%? If so, they still have a long ways to go, and the market's going to have to reprice some of what they think right now. I don't think they'll anticipate going all the way down to 2%, but I'm actually in the camp that I'm not so sure the Fed is done. I know that the futures is pricing in a 25 basis point hike at July meeting, but I still think they might go further, and I think the dot plot today is going to give us a good look into that. If they raise their expectations to where the IMF came out earlier this week and was putting growth expectations, then that means 2 more rate hikes at least. So we'll see what happens. I think this afternoon could be interesting.
With that in mind, do you think this chairman cares about looser financial conditions, higher equity prices?
Well, I think he does care about financial conditions. And, you know, this is part of the reason that I think the Fed is not done yet. When we look back over the last few months, what are some of the things that were coming to fruition where the market said, look, the Fed can take a pause because we're getting tighter financial conditions? We had the banking crisis. We had housing doing poorly. We had spreads starting to widen out a little bit. All of that has changed. We've got bank lending moving back up to where it was prior to March. You've got housing turning around, and housing prices, Jonathan, lead rents. So if everyone is anticipating rents coming down, and it makes up 40% of the CPI number, it looks like rents could start to creep back up again. We've got spreads tightening, equity market higher. So financial conditions are actually easing. That goes exactly against what the Fed wants to do. So I think they are paying attention to it, and it could set us up for a more hawkish stance than maybe what people think.
This is almost exactly what Greg Peters of PGIM was alluding to in the last 30 minutes, Victoria, which makes me ask the question then, just reading through your notes, why have you been adding to tech if that's what you think is going to happen over the next few months, the next few quarters?
So, I think everyone believes that if someone is bearish, that they're completely out of the market. And that's not where we have been. We do think that we're going to get, what do you call it, a pullback, a mild recession, whatever you want to label it later this year. But that doesn't mean that we're out of the market. We're trying to find places within the market that have some opportunity. And part of portfolio management is to have risk parameters around your decision making. Our risk parameter was telling us we were too underweight on some of the tech names. So we were adding a little bit to names. Salesforce pulled back. We added a little bit to that. Alphabet pulled back. So we added a little bit more to that. We're still underweight in tech, and especially in certain names, but that doesn't mean that we don't want some exposure there. We just are still a little bit underweight and are trying to find other areas in the market that we think can have a better leg forward as we go to the end of the year.
Do you subscribe to the theory pushed by the likes of David Costa and Goldman Sachs that this rally can broaden out?
Well, we've seen it, right? Over the last couple of weeks, breadth was a huge concern for us, and we actually talked about that last time we were together in regards to such a small percentage of the Russell 3000 being above their 20-day highs. We've seen that broaden out, and that's a positive sign. I don't want to negate some of the positive elements that are in the market. I just think it's not enough at this time when you still have 13 continual months of leading economic indicators coming down, 12 months of an inverted yield curve, still waiting for the effects of 500 basis points to work its way through the economy, wages staying higher, unit labor costs going higher. I just think you have to look at the whole picture, and in that whole picture it tells me, yes, there's some positive elements like breadth improving, but there's still a lot of negative signs out there that tell us we need to be cautious with our clients until we get through the end of the year.
So let's say I'm a client, I call you up, I've been stuck in cash all year. Tom Keene made me do it. I want to put some money to work in the equity market. I've missed the rip. What are you telling those people now?
Yeah, so we're actually telling our clients that we need to have that diversification in your overall portfolio. Hopefully, being in cash, at least if you were in a money market fund or a treasury fund that was giving you 5%, at least to give you a little bit of a cushion there. So you can have a little bit in cash. You can invest in the fixed income market and get 5.5% on short-term treasury bills. But I think in the equity market, you want to look at some elements that have been downtrodden. Look at a name like a McKesson in healthcare that has that, as you talked about a moment ago, an AI component because it's healthcare information technology. You can look at some of those tech names that have pulled back, but I also think you need to build a little bit in those staples, especially since they've pulled back, a name like a General Mills or a Kimberly-Clark that will continue to do well even as we go into the volatility we think we'll have fourth quarter of this year.
Help me understand what's going to happen here. If I listen to you correctly, you're still expecting a recession, potentially seeing this inflation downdraft as somewhat of a head fake, to use a word that Greg Peters used earlier, transitory. So sticky inflation, softer growth profile, where's that going to leave the margins of some of these companies?
It's going to leave it pretty tricky. You look at productivity falling. We look at wages continuing to do well. And even if you don't want to just take wages straight from the labor report, look at the Atlanta Fed wage tracker. That's telling you that wages are sticky right now. And it's not just in certain sectors, it's across the board. So you have unit labor costs going up. That compresses margins pretty dramatically. And we've actually had 2 negative quarters of earnings, right? We're in an earnings recession. I think the margins will continue continue to be compressed, even though you have a consumer that continues to spend. The pricing power, we've heard in earnings calls, pricing power is dissipating for some of these companies, and that can lead to layoffs. That's where you get that weakening in the labor market, and it flows through from there. So it's kind of a snowball effect, but I think it starts with low productivity, higher wages, and goes from there in regards to margins.
If you are just tuning in, about 14 minutes into the session, this equity market almost totally unchanged. Victoria Fernandez across Mark still with us. Victoria, just a final topic for us to go through. Federal Reserve later, Chairman Powell this afternoon. What are you expecting from the Chairman of the Fed a little bit later?
So your question is, what do I expect them to do? I expect them to actually skip this meeting and maybe go back into the 2018 mode of skip a meeting and then hike at the next meeting, skip a meeting, hike at a meeting. Maybe that's what they start to do in order to make their way towards a pause. If I was on the Fed, though, I would actually be voting for a hike at this meeting. I think they're playing a very dangerous game with financial conditions easing instead of tightening, a still pretty decent labor force, consumers still spending. I think they're playing a dangerous game and thinking that inflation is going to stay where it is or come down. It could move higher, and they need to nip that in the bud now instead of waiting and seeing it come even more later.
Would you expect some dissent later on this afternoon then when that statement drops?
I do. I think there will be some dissent, and I hope there are, because it tells me that there's some good conversations going on there as to what they really need to do and what they need to focus on. So I hope there are some dissents. I think that that's going to be a positive for the market, and obviously the press conference will give us a little more detail, but I think the story is what the market has already priced in. Skip this meeting, and then we probably see futures go even higher than where they are now for a 25 basis point hike in July.
It's a skip, but right now the Fed does not want to call it the end. Victoria Fernandez,
right.
Thank you. Which is why they don't like this word pause right now. It's a three-part act. We get the statement, you get the projections, the summary of economic projections, unemployment, inflation, growth, and a projection in there as well about where they see the future of the federal funds rate too. Look out for the median dot. Then it's on to the news conference with Chairman Powell at 2:30 Eastern time. About 16 minutes into the session, waiting for all of that. The S&P, some muted price action, positive by 0.1% on the S&P. On the Nasdaq, a very similar move. Coming up on this program, where the drama has been, former President Donald Trump delivering his defense.
This is called election interference and yet another attempt to rig and steal a presidential election. I had every right to have these documents.
The former president on the campaign trail, that conversation up next.
witnessed the most evil and heinous abuse of power in the history of our country. This is called election interference in yet another attempt to rig and steal a presidential election. It's a political persecution like something straight out of a fascist or a communist nation. This day will go down in infamy, and Joe Biden will forever be remembered as not only the most corrupt president in the history of our country, but the president who, together with a band of his closest thugs, misfits, and Marxists, tried to destroy American democracy.
Former President Trump on the offensive, speaking to supporters at his Bedminster Golf Resort after pleading not guilty to federal charges for allegedly mishandling classified materials. Democratic lawmakers are pushing back.
As we all know, in America, nobody is above the law, not even a former president. And I think that the American people, regardless of where they stand on Donald Trump, former President Trump, should allow the process to play out through the court system in a peaceful manner.
Very serious issues. Joining us now is AMH Dan in Washington, D.C. Anne-Marie, quite a 24 hours.
Yeah, it was. And Jonathan, we should note it's not just Democratic lawmakers that are pushing back. I have a list here. Senator Lisa Murkowski, Shelley Moore Caputo, Tim Scott also wants to be the candidate though for 2024. Pretty damning, serious charges, serious allegations. You can see the rhetoric is starting to ramp up, at least when it comes to the charges, although many also continue to say that they want to look at how they believe, at least on the Republican side, that they think the Department of Justice may be weaponized. When it comes to the former president, after he was arrested yesterday and he made this pit stop, which really felt like a campaign rally and then a speech, this was a little bit, Jonathan, of a window into his defense. He said these boxes were containing all types of personal belongings, many, many shirts, shoes, everything. I haven't had a chance to go through all the boxes. It's a long, tedious job, takes a long time, which I was prepared to do, but I have a very busy life. I'm sure his legal counsel does not want him openly talking about the case, but potentially you can see the kind of rhetoric and the pushback the former president is going to have, because he is not just a former president that now is under indictment and arrested and has to face these federal charges. He is also campaigning to try to be the candidate for 2024.
Anne-Marie, as you said, it feels like one big campaign. It's not. It's a court case. What's the timeline for it now?
Well, we're still TBD, Jonathan. There's going to be a number of motions, I imagine, the Trump team is going to make to try to slow down the process. They want to have this be a long, drawn-out process. The former president, in terms of a lot of reporting out there, is still trying to boost up his legal team, especially trying to find a lawyer who has a specialty when it comes to national security concerns, given the number of accounts against him have to do with the Espionage Act. The one date to look forward to at the moment, Jonathan, is June 27th. And so far, that is the only date we know, and that is a hearing for his co-defendant, Walt Nauta, but not in terms of when we're going to see the next steps when it comes to the former president.
AMH, thank you. On the latest, let's get you the latest price action. About 23 minutes into the session, more broadly on the S&P, we're positive by 0.2% on the S&P 500. On the NASDAQ, we're up by 0.2% as well. The chairman of the Federal Reserve just around the corner. Your Fed decision just hours away. Your trading diary up next. 26 minutes into the session, equities positive for a fifth day so far. Let's see what happens later on this afternoon. That's the price action, because later on today we've got the Chairman Powell Fed decision and a Federal Reserve news conference as well. Let's get to the trading diary. We look at a little something like this. Tomorrow we get retail sales and another round of jobless claims, plus the ECB's rate decision. On Friday we round out the week with UMich sentiment and the BOJ rate decision as well. Tons to get through the next 48 hours, tons to get through the next several hours as well. This was the countdown to the open. Good luck for the rest of the trading day. This is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day, Wednesday, June 14th. Here are the top market stories we're following for you at this hour. Mission nearly accomplished. The Fed will most likely pause after 15 months of hikes. We're going to take a look at how Powell leaves the door open for more. And play the pause. Equities pretty much go nowhere. A little bit of buying in the bond market. We try and find the biggest misprice in the market for a Fed skip. And limits on big tech. Microsoft's takeover of Activision is temporarily blocked by a California judge. And Europe accuses Google of using its dominance in ad tech to crush the competition. We get you the latest. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. Guy, I will see you back in about 4.5 hours time.
I will see you next week. And here's the reason why. The Fed's going to deliver a hawkish skip, whatever that is. It sounds painful, to be honest. The ECB is going to do 25 basis points, and the BOJ is going to do nothing. Can I go home now?
Seriously, we're all kind of waiting and drumming up some action here, but is there actually a misprice in the markets for what we're going to see today? I mean, there's going to be questions, sure, like how you telegraph stuff, but is there a misprice in the market?
Cameron Kreis was making the point a little bit earlier as well. How do you deliver a hawkish skip if everybody expects a hawkish skip? How does that work? The market, it's either really kind of chilled out or it's complacent. Can't figure it out. Presumably one of these three massive events has to deliver a surprise.
You're like this close to talking about the BOE next week, aren't you?
Yeah, BOE. There's some surprises coming there, I think. Anyway, as I say, I think a hawkish skip sounds really painful, but maybe that's what Jay Powell has got to deliver a little bit later on. He probably is looking for some dissenters. He needs some cover here to signal that maybe we are going to get a 25 basis point hike at the next meeting, or maybe it isn't next meeting. Maybe it's further down the road. Let's try and figure it all out. Should we take the rest of the week off? Ira Jersey, Bloomberg Intelligence, Bloomberg's Kriti Gupta on the market side, on the equity side, joining us now. Ira, can I take the rest of the week off? What is a hawkish skip, and is that what we're going to get today?
Well, so a hawkish skip is the opposite of a dovish hike, which was what we had in May. So it's basically the Federal Reserve leaving the door open to a hike and almost pre-committing to a hike in July. I think though that if the Fed does skip today, then the single biggest market mispricing in the front end of the rates market is the idea that you're going to have close to 100% chance of a hike in July. Because if the Fed skips now, there is a significant risk that we start to see continued slowdown in inflation data, and if we see even any kind of slowdown in the wage data from the June payrolls report, then the possibility that the Fed is going to pause again in July just means that the market has to price in that eventuality, and right now we're pricing almost for 100% chance of a hike.
Right, so we're actually pricing it, the biggest misprice is not pricing in a cut, a hike, I should say, for July.
A pause.
See, it's
not
confusing.
pricing in a pause, right.
Not pricing in a pause for July. Okay, so Kriti, the market, honestly, the equity market seems to have a nice resilience here. Where's the biggest misprice for a hawkish skip?
Well, I would argue that, and again, I always kind of take the side with the equity market. I feel like they're pricing it in just fine, because if you look at what the S&P 500 is doing right now, it's only higher by 0.2%. And if you look underneath the hood simply of what you are seeing in terms of the actual movers, your outperformance is coming from your classic tech players, which again is coming from some fundamental stories. The idea here that you have AMD, for example, looking at a new AI story. You'll have Tesla improving some of their margins potentially. So it is a sum of all parts game when it comes to equities. But from a macro perspective, I think it's worth suggesting that perhaps this might be a little bit of buy the rumor, sell the news. What's interesting to me about the market action here is that traditionally on Fed days, the 2 days prior tend to be sell-off days. The morning of tends to be a little bit of a sell-off, a cautious tone. To see green on the screen on a Fed day, hours before the decision, that's unusual.
So, Kriti, is this complacency? I look at what is... The headline levels are great to look at, and we all spend a lot of time focusing on them. But volatility is super low right now. In theory, you could argue that maybe a skip is good for equities. I've read a couple of notes on that front this morning. But the market seems remarkably becalmed. In theory, this is a major event that is taking place here. Why isn't volatility higher? Maybe that's what is mispriced at the moment.
I would argue, again, that I don't think this is complacency at all, and I think it's shown by the fact that volume is actually higher on a 5-day basis. That being said, if you look at some of the year-end price targets, we're already there when it comes to the S&P 500. So something that a lot of people are talking about is not necessarily complacency on they or won't they hike in this meeting. The complacency is for the next 6 months here, saying that essentially all the gains, all the growth that you're going to see for the rest of the year, it's priced in. So I don't think it's necessarily a Fed story specifically when it comes to the equity market. It's simply the idea that if you're talking about a recession, all the positive is priced in. It's just a question of when to sell.
So I guess, then the question leads me to today, specifically, how do we get that hawkish skip? Because that will also help dictate sort of where the optimism is priced in both markets. Is it through the dot plot? Is it through a revised inflation forecast? As you pointed out, do we need to see more dissents to get that hawkish skip? Like, where will we actually see that?
Well,
I think possibly
if that's a question to me, Alex.
Well, no. Let me put that question to you, Ira. What do you think? I wonder if it's in the dissents. For the next meeting, I think Powell needs some dissents today to give him some cover to signal that move for the next meeting. But I'm wondering what the dot plot signals further down the road. So give me two answers. One next month, one in 6 months' time.
Well, I think firstly, I agree that the idea that you'll have a hawkish dissent or two is highly likely. There are certainly a number of members of the committee who have said, like, we think that we should not be pausing yet. But then you have some other more dovish members that have also joined the Fed. So it wouldn't completely shock me if we did see a pause that led to a continued pause and the end of the hiking cycle. But the dot plot, I think, would give the clearest signal that a preponderance of the committee does believe that there'll be another hike. Because right now, remember, they're basically at where the dot said that they would be. Mm-hmm. So you would have to move the dots a little bit higher, at least on average, and with the median moving higher in order to convince the market that the Fed was serious about potentially having a hawkish pause today.
Hey, Ira, do you really think that the Fed wants to hike in July, or do they just want to not have cuts priced back in to the market?
Probably not have cuts priced in to the market, and we have priced out some of the cuts that were originally priced in for the better part of the first half of the year so far. So I think that in that regard, the Fed's done a halfway decent job in suggesting that, hey, because we might hike in July, that means that we're definitely not cutting in November, December. But the market still is thinking like, hey, if they do hike in July, maybe in December they're going to cut, and it's that kind of odd path that the market's pricing for the risk that another hike will lead to even a deeper economic slowdown later, and therefore the market's pricing this continued inversion of the front end of the yield curve in large part because the risk is that the Fed goes too far and has that policy error that it almost always makes in going too far and creates a large dislocation in the economy later on that causes them to have to cut interest rates very aggressively.
Alex, the one thing we haven't talked about yet is the PPI data, which in theory should be a harbinger of what comes through CPI. I don't think there is a direct one-for-one kind of connection here, but in theory should provide some sort of a guidance. If we are seeing producer prices coming down, presumably consumer prices will follow. But then I look at it from another angle as well, which is if producer prices are coming down, is this good for stocks? Yeah. Because you talk to a lot of CEOs at the moment, what they talk about is, yeah, the top line's fine, it's my costs that are really hurting me right now. And if they start to come down, and I know we've seen some evidence of this, maybe that's good news for the stock market. I was going to say the same thing. That isn't that the juicy part. If PPI comes down, but CPI stays relatively elevated, maybe you're reaching the peak of what you can price on in terms of pricing onto consumers, but you can still price it. I mean, that's kind of good for margins, Kriti, no?
It absolutely is. And I think I'm glad you made the CPI, PPI point, because one of the kind of cases for the idea of a pause this meeting and a hike the next is simply that if you look at next month's CPI, this is a point that the UBS chief economist made on Bloomberg TV earlier this morning, all other things equal, CPI is bound to drop anyway. Your commodity prices, your housing prices, et cetera, simply as a function of base effects. So you are going to see it show up in the data. Even if there is no actual macro improvement, everything stays the same, you are still going to see the improvement in the data. And that could be a reason for the Federal Reserve to say, hold on a second, in 2 months' time, look, our process is working.
Right. Fair enough. All right, guys, hey, thanks a lot. Really appreciate it. Ira Jersey, Bloomberg Intelligence, Bloomberg's Kriti Gupta. Thank you so much. Busy day for everybody. We appreciate your time. So coming up, we're going to get more insight to that question of the day, hawkish skip. How do you price it? What does it look like? Ankur Crawford is portfolio manager at Algier Capital Appreciation. Joins us next. This is Bloomberg.
Today, will the Fed pause or hike?
The steepest tightening cycle since the 1980s may be about over.
It's a we've never been here moment. And where will they go from there?
They may leave the door open to additional rate hikes.
They say pause and this market hears cuts.
Trust Bloomberg for the fastest coverage and exclusive analysis.
What could potentially torpedo this?
You're not really seeing the slowing in the labor market.
Bloomberg Surveillance. The Fed decides. Today on Bloomberg, your global business authority.
Skip is the right term to use because they're going to be communicating that they have to be flexible, that all options are still on the table, and they're going to do what is necessary to bring down that inflationary trajectory in due time.
That was Michelle Meyer, MasterCard Economics Institute Chief U.S. Economist, talking to Guy and myself yesterday, which brings us to the question of the day, hawkish skip. Joining us now for her take is Anchor Crawford, Executive Vice President and Portfolio Manager at Alger Capital Appreciation. Anchor, thanks for joining. Are you expecting the hawkish skip? Is that what we get today?
Yes, expecting a hawkish skip, but does it really matter?
Does it?
I don't think it does, in part because, we are 90% of the way there already of what the Fed needs to do. And I think the bigger question that no one is really broaching is how dogmatic are they going to be about 2% inflation? Because if it is 2% inflation and that is their target that they stick to, they're going to have to do more. If they're a little bit willing to look at 3% or 3.x%, I think they can engineer a softer landing.
Anchor, do you think the Fed's credibility at this point, or the credibility deficit the Fed has at this point, will allow it to make that switch?
I think it's not a matter of credibility. I think, we have to give Powell a little bit more credit than that. I think he's going to try and do what is right versus protect his ego and the credibility associated with the Fed.
So if that's the case, is the market at all mispriced?
So I think the market's being driven by a few different things that are ancillary to what is going on with the Fed. I mean, clearly, we hear every day about how the AI stocks are driving the market. I think if you look through each of the end markets, we are having cyclical recessions. Consumer is kind of in a cyclical recession. Tech went through it last year, and numbers are starting to move back up. So is the market mispriced? I think in some cases it is, and in other cases in the market it's not, which it makes it a great stock pickers environment.
Stock pickers, yeah. Alex, I'm not sure about the bond market though. You think about what is happening with the bond market right now. There has to be an anticipation that ultimately we get down to 2%. How mispriced is the US 10-year if the Fed is prepared to accept 3%? Quite significantly, I would argue.
Well, yeah, and we just heard Ira Jersey talking about the fact that what's really mispriced is that 100% surety of a hike in July. That's the other side of the coin. So, Anchor, what do you think? I mean, where is the biggest mispricing in the bond market?
Yeah, I think it could be on the 10-year in that, it probably needs to have a little bit of a bounce from here in order to, A, slow the economy if they want to get to 2%. But if they are willing to move a little bit on that target, maybe it's not mispriced.
In terms of, there's a lot of money sitting on the sidelines at the moment, Anchor. A lot of money in money market funds, just trying to figure out what to do. Do I chase the rally? Do I stay where I am? Am I getting paid to stay where I am? Do I wait for a better opportunity? What's the right answer to that question? Should people be getting out of money market funds and putting capital to work? Should they be sitting there, sitting tight, waiting for a better opportunity? How are you thinking about it?
If you look at the market today, it is trading at an 18 point some multiple. And when we started the year, the expectation was that we were going to have a down year, kind of $200 in earnings for this year, and 2024 would also be kind of a flat to slightly up year. If you look at the numbers today, it's more like 220 for this year, so the numbers have moved up. And we're looking at 2024 as being an up to, a pretty good earnings growth year, in part because of the margin profile that you guys were just talking about with the PPI and the inflation coming down.
So you feel that companies can hold on to their margins then? They're not going to have to sort of readjust their prices if there's a slowdown?
I think a lot of industrial, like if you take the industrials complex, they're going to have the advantage of getting inflation declining and holding pricing. But, you know, it's also, you have to disaggregate which businesses can hold the pricing versus which businesses can't. And so when you talk about the overall market, you know, you can't just buy the market because there is a differentiation between which businesses actually can make it through versus which can't.
Anchor, I hear what you're saying about you can't just buy the market, but just buying the market has been the right strategy for year after year after year. I hear what you're saying when you say it's a great stock pickers market. In theory, it should be a great stock pickers market. But this year has confounded all of the ideas that we've had. We thought we were going in that direction, but it turns out we were going in that direction. We are finding it very difficult to settle on a narrative at the moment, and that probably is indicative of the fact that we are maybe at a significant turning point in a number of different factors. In theory, it's going to be a good market for stock picking. How easy is it really going to be to pick stocks in this environment?
I don't think it's ever easy to pick stocks in any environment, but I think that if you focus on the thematics of, AI is going to be a huge driver of over the next decade for businesses, for those companies that are going to be adopting AI and the margin profiles. It adds a huge amount of productivity, a huge amount of cost savings. So, you know, as you start thinking through the businesses that can benefit from either enabling that trend or adapting and adopting AI into their business models, it can drive a massive amount of earnings power. Just this morning, Jefferies had a note out talking about how enterprise spending can come down by 20 to 25% just by the adoption of AI over time.
Wow. That really hurts the providers of that, though. But then, Guy, you know, to the broader point, sort of the winners and the losers, right? Like, how do you pick them? And also, we could still be in a bubble, but it could also still be a good secular, right? It could still be a real trend that we're going to see for the next few decades.
The internet changed everything. The internet completely shook everything up and changed the economy forever. This is probably more significant than that. But we had to go through 2000 to sift out the wheat from the chaff. And you look at some of the numbers that some of these stocks are trading on right now. Nvidia obviously is the kind of the poster child for all of this, but there's plenty of others out there as well. They are already trading on punchy multiples. So do you continue to chase that? Do you pull more money in to work in that area? Can you figure out where the next step is? I don't know. I think it's going to be tricky. We're off to the races. We're going to go a long way. But figuring out which are the winners and which are going to be the lesser winners, I think it's going to be tricky.
The lesser winners. So, Anchor, how do you do that?
Yeah, so, you know, we have this argument about whether we are in an AI bubble. You know, yes, Nvidia does trade at a punchy multiple today, but last time I was in here, we talked about that, and we said the numbers are way too low. And they were too low, and all of a sudden that super punchy multiple became less punchy. However, I don't believe we're in an AI bubble right now. I mean, just 2 weeks ago, you could buy Taiwan Semiconductor for a 13 multiple on street numbers. And so a 13 multiple for one of the best businesses on this globe, with geopolitical issues nonetheless, but you know, that doesn't feel bubble-like to me. You look at businesses like Marvell. Marvell trades at a 20 multiple. It's a 10% premium to the market. Also going to be catering to this AI landscape. That doesn't seem too punchy to me.
Yep, fair enough. It is difficult to pick and figure. Maybe you just buy the lot of them. Maybe that's a way of kind of dealing with that. It's always been the biotech story, hasn't it? You can never figure out what the winners and the losers are going to be. At some point, they are going to, as a group, generate some really good returns. Anchor, great to see you. Thanks for stopping by. We really appreciate it. Anchor Crawford of Alger Capital Appreciation. Still ahead, we need to talk about what is happening with the EU. It's accusing Google of abusing its dominance over ad technology to crush its competition. We'll talk about that. We also need to be talking about the fact that the UK Treasury Committee has sent written questions to the FCA about what is happening at O'Day. We'll talk about that